Hello, and welcome to Ask the Experts. I'm your host, Sean Lichterman, cost segregation consultant with CSSI. Today, I'm joined by my great friend, Aaron Abbadie with Align Real Estate. He's a broker that specializes in multifamily units and properties. And today we've got an exciting content to share with you. We're going to dive into the world of real estate investing, specifically with multifamily units and how this is great for building generational wealth. And then I'll be talking about the tax savings advantages that are out there for real estate investors to take a hold of. So without further ado, Aaron, thanks for joining us today. Appreciate it. Give us a little background on yourself. This is your plug time.
Yeah, no, I appreciate it. Thank you for having me on today, Sean. It's great how we met on LinkedIn and how, these platforms make the world so much more tight-knit. So I appreciate you having me on and us, nurturing this relationship that we have together. What you do and what I do, where the worlds intersect is very valuable for our clients, and learning how it is that you can utilize cost segregation is so important to accelerating that wealth building process. So I'm really excited to learn more about how it is that you help these mutual clients that we serve, and how we can do more and more business together and provide more value for our clients. So I've been selling real estate for the last 7 years, mostly residential, but I've started to focus on multifamily because it's something that I'm passionate about, and I know how important it is to use multifamily real estate as a vehicle to build wealth and leave a legacy for your family, or build cash flow for whatever it is that your goals are. So very excited for our discussion today.
Excellent. Yeah, you've definitely been a pinnacle of the Central Florida market. I know even on a personal side, you've been helping my wife and I actually scope for multifamily investments for ourselves. So working with you personally firsthand, yeah, it's been great. You're a wealth of knowledge, and that even following your newsletters, there's stuff in the market that I didn't know, which is great to come across. I think that's one of the great things about real estate, is that it's constantly ever changing, and there's a chance to learn something new, whether it's market trends. I recently saw that you just got your lending license, so congrats on that. I'm sure you'll share a little bit about that. And then also, as you know, real estate has some of the best tax savings advantages for investors. So this really becomes a hot pot for our demographic, whether it's in Florida, throughout the U.S. But this is a chance to really not only provide some cash flow, some early on wealth, but then, as you said, create that generational wealth that you can pass on to your heirs. A little bit of my background, if you're new to our discussions, our channel. My background actually starts within pharmaceutical and tech sales, but I come from a pedigree of real estate investors. My grandfather was a city developer in Chicago, and my dad was a flipper. So as a kid, through my teens, I used to be on the job sites. I was really the wrecking crew, the demolition duty. So that's how I got my feet wet into real estate. But as I grew older, I went into a couple of real estate investments with him, some friends. And actually, he got into cost segregation about 12 years ago. So when I was in my tech side, I would really be the referring partner for him, as clients would come to me and say, hey, we just opened up a new location, a new office, a new business. And I'd simply ask them, did you receive your tax savings benefit yet? I say, no, what's that? Well, it's cost segregation. Let me ping you to my dad, and you guys can have a discussion, see what this estimate looks like. And I did that for so many years, to finally 3 years ago, I ended up jumping into it right during the pandemic. So ever since then, real estate has really been a true passion of mine, as well as my family's. And tax savings benefits, well, that's a passion of anybody's.
That's amazing to hear that you grew up with the real estate background and so many people around you actively doing deals. That must have been fun to be a part of, even though you probably didn't know as much as you do today. Having that boots on the ground experience is definitely valuable. So we know that wisdom comes with the definition of terms. Cost segregation sounds like a really cool word. Can you go ahead and explain what that is?
Yeah, so for any real estate investors who are new to the industry or have been doing this for a while, if cost segregation is an unfamiliar term for you, I highly suggest putting this at the top of your list. The reason being is that it's a very advantageous tax savings tool. Now, what cost segregation does, it looks at a building and it breaks the components down into its separate asset class categories. And it's going to accelerate those asset classes that you could then utilize as tax savings within the earlier years. So if we look at depreciation, I'm sure everyone's is familiar with depreciation. It's actually a good thing when it comes to real estate investing. It's not the same as buying a car and saying, well, it depreciates the moment you drive it off the lot. That's bad. But in real estate investing, it's actually good. It helps you offset your gains and therefore offset your tax liability, which then improves cash flow and allows you to buy more property from Aaron, renovate, or what I tell my clients, take a trip around the world. But we'll get a little bit deeper into that and how the study and analysis actually pertains. We'll get into the different asset class categories and then ultimately discuss what the tax savings could be, the real life after tax savings could be for you on some specific examples.
Awesome. Very good. Looking forward to it.
But real quick, what I did, I took a poll from some commercial real estate executives, and I wanted to really dive into the minds of these individuals. And a couple of questions I asked were, what aspect of multifamily investing would you like to learn more about? As we can see, finding lucrative multifamily deals. So Aaron, if you can discuss a little bit more on that, and then evaluating market trends. And you may also even want to plug a little bit of the lending side onto evaluating market trends and maybe evaluating lending options out there. And then on the tax savings side, we see that a lot of these commercial real estate executives said some of the most underutilized tax saving options out there are cost segregation 1031 exchanges. So that's why I really want to pull these two worlds together, because once you can find lucrative deals and you can save your taxes on the back end, God, it's like putting kerosene on an already lit fire. And we've dealt with a lot of clients that have figured this concept out, and that's why you see 25, 30-year-olds, 40-year-olds who have portfolios worth multi-millions of dollars. So we want to share that insight with you as well. Let's dive into the multifamily arena. I think we got to talk about pre-sale, right? So when you're working with a client, how do you scope? Let's talk about some market trends. What makes multifamily deals so exquisite and compared to other ones? And then, once we get post-sale, I can start talking about the tax savings advantages.
Well, I guess we can start with, how it is that I would advise someone who wants to get into the market for multifamily real estate. Of course, we always start with motivation. What is it that is pulling you towards your goals for buying a multifamily property? Because, buying multifamily real estate, it's not an easy feat, right? You're going to take risks. There's so much responsibility that comes with owning a property, not just with maintaining the property, but on the back end. Like if you don't do these cost segregation analysis, if you don't, upkeep your tenants and be a good landlord, you can drop the ball and it could cost you. But on the flip side, there's so many positives that do come with owning a multifamily property, like cash flow, appreciation, depreciation. We can go down the list, but it really starts with understanding the client's motivation for getting into the arena. Once we know exactly why the client's getting into this sector, we can identify their willingness to engage and start defining, how big of a deal are we going after, right? And then, of course, financing is a big part of it, but really understanding what type of investor you are is going to help me go to the market and find the best deals for that specific investor. So finding deals is a matter of learning more about the investor and seeing how hands-on or hands-off they want to be with this particular investment. And everyone's different. So really understanding, again, your willingness to engage and how hands-on you want to be will help me as your advisor guide you in the right direction and identify the best path forward. So if you want to maybe give me an example, I can dig a little deeper.
Yeah, and I think what I picked up there is that, it all depends, right? It's like buying baby diapers. It all depends. And it all depends on your investor, what their price range is, what their experience level is. And I'm sure what market are they looking at? Are they looking for a primary market, a secondary market? Are they looking for an up and coming market? So maybe it's best to kind of share us, what do you typically work with? What do you like to work with? And then also what I hear a lot is, well, real estate investing, multifamily investing, it just sounds so expensive. Can you maybe give us some real world examples of how much capital you really need to put towards down payments, if you want to get started, and maybe what's a good starting point for some real estate investors that, just got a little bit of cash they've saved up through their 20s and maybe their 30s, and they want to start getting into the real estate world. They're not looking for the $1 million duplexes or fourplexes and things of that sort.
Right. So we'll focus on 2 to 4 unit multifamily properties, duplexes, triplexes, and fourplexes. The cool thing about 2 to 4 unit properties is that they fall under residential financing. So you need no experience to buy 2 to 4 unit properties. Whereas with 5+ units, if you were looking at a 6-unit apartment complex, that falls under commercial financing guidelines. So unless you had the cash to buy a 6-unit property, the financing is much different. They want to see that you have experience before taking on such a big property. But the cool thing about 2 to 4 unit properties, you don't need any experience. And if you use an FHA loan or FHA financing and you're willing to live in the property for a short while, you can actually use the scheduled income of that property to help you qualify for a larger loan amount. So as you mentioned, these multifamily properties are a little more expensive, but if you were to look in, a secondary market and find a duplex for $350,000, you can use the active income in one of the units as additional income to help you qualify for that $350,000 price point. So I deal with more millennial investors, as you could imagine. I went to UCF, I rushed a fraternity. So a lot of my friends did buy their first single family home from me or duplex from me and house hacked it. And I think that's one of the best ways to get started. If you can take on that responsibility and your willingness to engage is moderate to high, and living in the property is something that you could stomach for at least the first 6 months, then that's definitely the best way to catapult your wealth and get into a high quality asset for a relatively low down payment. So with an FHA loan, you can buy a multifamily property as big as 4 units, only putting 3.5% down. And especially in today's market, sellers are very motivated. And if you can work a deal with the seller where they're willing to negotiate with you and let you use an FHA loan to buy the property, which in most cases you can, then you can get into a cash flowing property for very little money out of pocket, relatively speaking.
Wow, that's incredible, and I like how you touched upon the house hacking, because that's a term that I wish I had heard back in my 20s. Paying rent to landlords, it just seems like I was throwing money out the window. But if I could look at a duplex or, like you said, a fourplex, put 3.5% down, if I'm looking at a $200,000 or $400,000 duplex or fourplex, that's very manageable. And then I can rent out the 3, live in the 1, hopefully offset my mortgage payments by the other 3 until I've received enough cash flow from those 3 rentals, and then go do the same thing all over again. This is a tremendous strategy, especially if you're young and you don't mind doing a little bit of elbow grease in the place that you work in, or I'm sorry, the place that you live in. And this is really going to propel you into the early start of attaining a real estate portfolio. So I appreciate you sharing the house hacking tutorial. 100%.
And, the first deal is always the hardest, and it's the most important one, because that's what's going to create the momentum that allows you to take on that second property. And if you're willing to live in the property and have the other units that use that other rental income to offset your mortgage, like you said, allow you to save up for that second property, you can then stabilize that asset and do it all over again on the second property. You don't need the 20% as most people think if you're willing to live in the property and be a landlord for a little bit, which is a great skill set that anyone should aspire to learn, especially if they're going to dream about having a big portfolio. So
exactly,
definitely a great first step.
Yeah. Now, what would you say are some of the hurdles or maybe pitfalls, maybe currently in the market, that investors should at least be weary of or just be cognizant of?
So I think everyone's very mindful of interest rates right now. Mm-hmm. So it's very difficult to feel like you're going to cash flow a property with today's interest rates, and it's true. Unless you get a really good deal, on the purchase price for a duplex, you're probably not going to cash flow it right out of the gate. But it's forcing our investors to either buy bigger and buy 4-unit properties where there's more units available, there's more upside potential. It's called the economies at scale, right? A vacancy hurts you a lot less when you have 3 tenants, because you have 2 other people that are paying you rent every month. So if something breaks, if someone moves out, or if you're having a tenant issue, it lessens the blow knowing that you have 2 other tenants paying rent every month. So higher interest rates are causing buyers to be a little more conservative. So you're either buying smaller, buying a duplex under 300,000, which is going to force you to go into a secondary market where the rental market's probably not as strong, or you can buy bigger as long as the numbers pencil out and you can get good tenants in there. Buying bigger usually is the solution to higher interest rates because you can cash flow the property.
That makes sense. That makes 100% sense. Are there any other tricks into kind of finding these lucrative deals, outside of maybe just doing Google Maps or like a Zillow or Redfin? One of the tricks I've heard is the Starbucks hack. As long as there's a Starbucks within a mile, it's probably a good area to invest in. But I've never tried it. I'm not sure how true that is. I've just kind of heard that, on Reddit lines that the Starbucks hack is one to look at. But if you got anything, of that material to share, that'd be great as well.
Yeah, so I mean, the Starbucks effect is definitely a thing. I like to throw Chick-fil-A in there as well. If you see a Starbucks, Chick-fil-A, a Publix, these are all companies that create kind of marketplaces. They help solidify a marketplace. So if you see a Starbucks, Chick-fil-A, Publix, anything near a deal that you're considering, that's how you can identify whether it is a deal or not. You can see that's in a growing marketplace, and that's good to see. But as far as finding deals, that's a whole different skill set altogether. A lot of people spend a lot of money on marketing to off-market property owners, tired landlords, distressed property owners, foreclosures. There's 100 different ways to look for and find these deals. But if you're just starting out and you don't have maybe a ton of money, or you don't want to throw a lot of money towards marketing, the easiest way to do it is to find what looks to be like a distressed property. If you see a duplex or a fourplex that's a little beat up, maybe there's some deferred maintenance on the property. It looks like they haven't taken care of their lawn, or you see that the roof is kind of old. It's 2023. You can skip trace anybody's information.
Yeah.
Skip tracing is just looking up the contact information for a property owner. So driving for dollars, right? It's the cheapest and sometimes the most effective way to find yourself a deal. And off-market deals, more often than not, are going to be much more lucrative, and you'll be able to secure them at a better price than having to purchase something on the MLS. Now, there's still phenomenal deals on the MLS, but just know that you'll be competing with other buyers who are also looking on the MLS for the same deals. And typically they're listed a little bit higher than if you were to engage an off-market seller. So finding deals, again, that can be a time-consuming and capital-sensitive activity. But if you're serious about getting the best deal possible, then maybe finding a wholesaler who looks for multifamily properties would be a strategic relationship to have. But if you're okay with paying a little bit more just for the convenience of not having to spend a lot of time or money marketing for off-market properties, then again, there's still plenty of good deals on the MLS. And today's sellers are much more motivated than they were 6 months or a year ago because rates are higher. So I'm finding that buyers who, are willing to engage a seller, they're pre-approved and they know what they want, make an offer on the property that makes sense for you. Even though it might not make sense for the seller on paper, you have no idea what the seller is going to say when they respond. And that's the best way to get, a formal response from the seller. So don't assume that your offer is too low or it's not going to work. It's better to shoot your shot than to not shoot it at all. So
exactly. No, and you touched upon a lot of great points there. The driving for dollars, the house hacking as before. I even picked up, I think the Burr method was thrown in there. The buy, rehab, rent, refinance, repeat. Where you're saying find like a distressed property, you can rehab it, rent it out, refinance once the market corrects itself, and then repeat that process all over again. Or work with wholesalers. So I think what I'm really picking up here is for real estate investors, it really just comes down to what amount of time do you want to commit towards this? Do you want to go all in where you're actually driving for dollars, going up and down blocks, working with wholesalers and finding these, call them, Goldilocks properties that are unlisted on the MLS? Or, if you're maybe say high income earners that want to get into the real estate industry and you don't really have that amount of time, work with professionals like Aaron. They're the ones that have they got the feet on the pavement. They're looking up and down the blocks, the markets, and by sharing the criteria, your experience and what you're looking for, that's how they're going to be able to fine tune and provide you a lot of opportunities that really fit your match.
So for people starting out, that's definitely a great place to start. Again, know thyself, right? It's one of my favorite phrases. Know thyself, know where you want to be, and an advisor like myself and Sean can help you fill in the gap. But maybe you're someone who has the 20% down, maybe you have the liquidity and you want to secure returns that are hard to find in other places of the market right now, right? 6 to 8% returns are pretty favorable in a market where companies are contracting, unemployment is starting to creep up a little bit, and you want to park your money in a safe investment. And I think if you have the 20% down and you want to be pretty hands off, which is another avatar that I find myself working with right now, you can find a new construction duplex in the secondary market like Poinciana, which is Kissimmee area, like 45 minutes from Disney. You can find a new construction duplex for about $500,000, and we actually have a builder who guarantees that each side will be rented for $2,000 a month for the first year, and they'll manage it for free for the first year. So even though your rate might be a little high and you're spending $120,000 to purchase this property, after everything, you might net $6,000 to $10,000 for the year. Your cash on cash return might not be super high, but knowing that your investment is safe, that you're getting all these tax benefits on the back end, which is where Sean comes into play. It's not just about the cash on cash return for year one, it's about the other tax advantages that you get, especially if you're a high income earner. So that's where Sean and I's role differ. I'm more on the front end. I'm helping you secure the deal and identify what a good deal looks like on the front end. And Sean, conversely, will help you identify all the benefits that come with owning this property on the back end.
Exactly. Yeah. The post-sale part. And, in my opinion, I think right now is probably one of the best times to get introduced into real estate investing. Contrary to what I'm sure a lot of economists are saying with the high interest rates, but if you can find a deal that's going to cash flow between 6 to 8% minimally, once the market corrects itself and you refinance, oh my God, is the cash flow just going to ever go through the roof? And as we're seeing in markets like these secondary markets, I'm in Tampa, Aaron's in Orlando, we're bursting at the seams as it is. So these secondary markets are so highly underdeveloped right now, and they're developing with communities and they're next up and coming, that if you can hold on to these properties for 10, 15 plus years, I mean, there's no reason why these secondary markets wouldn't grow like these kind of primary markets that you see in Orlando and Tampa, especially over COVID. We saw it was just bidding wars, right? Interest rates were so low, so people are paying 20, 30%, sometimes above that over asking price. But now that interest rates are so high, the buyer has a lot of leverage when they're going to the seller, right? So you're seeing a lot of these additional add-ons that they can get, either seller financing, although they can get some property management thrown in there. They'll be very flexible on closing costs and even purchase price. So if you're sitting on the sidelines and it's like, well, I'm going to wait for the interest rates to drop, I might say it's a little bit too late, right? And Aaron, I'm sure you might agree with that as well, that when the market is where it's at this point, if you can find deals that are going to cash flow, grab them. I know that's what we're actively looking at right now.
Absolutely. Yeah. And like you said, if you're waiting for interest rates to go back down so that things can become more affordable, think about how many other buyers are doing the same thing. Demand is going to creep up, and that $500,000 duplex is going to be $575,000. So, you're taking on more debt and you're competing with more buyers in the marketplace by waiting for interest rates to fall, when instead you could get in now, accept the lower returns for the short term. And when interest rates do come back down, you're already ahead of the game, because now that the value of the asset is rising, your cash flow is going to increase and your ability to refinance will be right around the corner. So, that's definitely a good strategy to get in now. And if you could put more money down, of course, that's great. But there's a lot of ways that you can get in if you're willing to live in the property with a minimal down payment. So that's where the lending comes into play. And that's why I got the mortgage license, just because knowing how to move money around to build wealth and to buy assets for yourself, it's amazing. And now being able to advise on both ends of the spectrum is really invigorating, honestly. So
That's great. That's great. No, and I'm sure you probably have now an even probably different or more perspective, growing perspective, I should say, on the real estate market. Now that you're looking at it, not just from a real estate broker, but then also from the eyes of like a mortgage lender. I'm sure that that's just opened up your eyesight to the market even more. If you don't mind, maybe we take a quick sidestep, because I know another side question that seems to be really hot topic as of now is the short-term rental market, Airbnbs, VRBOs. It's no surprise that Florida is the mecca of hospitality and vacation rentals. So I'm sure you do come across your fair share of Airbnbs, VRBOs. Maybe talk about a little bit of the advantages, disadvantages in that realm, how it differs from multifamily investing, who the proper investor background would be to look for these type of short-term rentals as opposed to maybe a multifamily investor.
yeah, so especially today with interest rates being a little bit higher, it's different than when interest rates were low, and you could look at it as a way to accelerate the amount of rental income that one property could produce for you, right? If you bought a duplex with 3.5% down, you live in one side and you stick a long-term tenant in the other, you're house hacking and you're getting the long-term rental income on that other side. But if you wanted to buy a duplex, live in one side and do Airbnb on the other side, you could totally do that, as long as you were compliant with local regulations and whatnot. But with today's interest rates, you're looking at it a little bit differently because you're not cash flowing as much. When you're paying for the utilities, you're maintaining, you're constantly turning over the property. Even though the tenants do pay for cleaning of the property, you have to pay for supplies and whatnot. Your expenses are much higher than having a long-term tenant in place, and the maintenance overall is much higher. So I think a short-term rental is a good thing if you're in a great location and there's strong demand for your property. For example, if it's near a popular beach and it's really accessible, it's walking distance from the beach, or if it's near Disney and it's in a neighborhood that has a lot of amenities, you really have to make sure that you're being conservative when you run your numbers, because today's interest rates are definitely making it harder to cash flow these Airbnbs. But for people who did get in when rates were lower, I think they're still, generating strong returns, and I'm genuinely happy for them. But today, I think if you're getting into short-term rental type of property, unless you're paying for it in all cash, it's becoming harder to cash flow these properties, because a rise in interest rates affects everything from the way that people spend money to how often they vacation. And I've noticed with the Airbnbs that I'm managing that April and May tend to be slower months anyways, and we're getting back into season now, but things have definitely slowed down a little bit, even with 1,500 people moving to Florida every single week. So there is a way to do it. You just have to be strategic with where you're buying and making sure that you're accommodating the type of tenants that be mindful of who you're hosting and what they want, right? Luxury properties, there's always going to be a demand for that and having amenities in the neighborhood. But if you buy an Airbnb and it doesn't have granite countertops and it's not furnished the way that 2023's vacationers expect it to see, then those are more expenses that you have to be mindful of. But I know that there's a lot of tax benefits that do come with owning these short-term rentals because of the expenses that go on with owning and operating these short-term rentals. I'm sure you can elaborate and share some insight on the amazing tax benefits. Would you say that there's more tax benefits with short-term rentals than there are for multifamily, or is it about the same?
There's definitely, they both have the same advantages. So you can take tax advantages on both. And I'll break it down into how both of those type of asset properties break down into cost segregation analysis, and then also how you as investors might even be able to double dip as a rep status to even pass that on to your personal income. But real quick, a couple of the points that I picked up from your last discussion here was in real estate, it's all about location, location, location. but that might be just a little bit more truer when it comes to Airbnbs, VRBOs, because that's really what you're reliant on. Whereas a multifamily building is going to cash flow in a secondary, maybe in a tertiary type of market. Not only that, but the short-term rentals is also going to come with some more intangibles, right? You have to be reliant on your rating system, the reviews you get. So making sure that this is up to spec to your guests is kind of a moving target, making sure that the decor is always up to date, it's very clean. So there seems to be a little bit more intangibles when it comes to short-term rentals, but also I'm sure, as you can attest, it could be very, very profitable if you find the right market, the right opportunity. And on a tax savings side, I'll agree 100%. There's going to be lots of tax savings advantages you can utilize from a cost seg standpoint. So, let's jump into it a little bit deeper. I know I've kind of teased it up a little bit as we've been talking, bringing us through. But I think it's great for our listeners to understand first the market, the trends, what's a good opportunity, what's maybe not a bad opportunity. Some initial advice on how to find properties either in secondary market, primary market, or whether short-term rental or even multifamily might be best for you. So now we're post-sale. So now we've owned the property. It's either multifamily or it's a short-term rental, and we're producing some cash flow, and we have a tax obligation. So let's get into the wonderful world of cost segregation, right? It's not really a sexy name. It doesn't really say a whole lot, but once you reap the benefit that cost segregation brings to real estate investors, you're going to be a lifer like I am. You're going to be singing this from the highest mountains, and everyone should get in on it. So a little bit more that we talked about. Cost segregation is that very generous and advantageous tax savings application that allows you to reduce your tax obligation in the earlier years. So when we look at a short-term rental, for instance, in that building, there are a number of components, from flooring to baseboards to moldings to the granite countertops, the different fixtures that go in there, the landscape. All these different types of materials are also segmented to asset classes. So they're either going to be in 5, 7, 15, or in the structural term, so 39 years, right? If it's a residential commercial property, it's 27 and a half. Short-term rentals is seen in the eyes of the IRS as a hotel, so it's held at a 39-year depreciation schedule. So that's going to be more of your structural items, those things that aren't going to break in 5, 7, 15 years. They're going to last the eternity of the property. So the benefit of being able to go in and segment those different asset class types of amenities is that you get to deduct those early on in the lifespan of the building. So once again, if we're looking at, let's do some round numbers or easy numbers. If you've got a $1 million short-term rental or $1 million Airbnb, and we say about 30% of that is classifiable for cost segregation purposes, we're looking at $300,000 of that purchase price that can be accelerated in year one. Let's take that a little bit further. We can even enter in what's your tax bracket. So if your tax bracket's in the upper 30s, take a third of that 300,000. You're looking at nearly 100,000, if not a little bit over $100,000 in after-tax savings. So on that $1 million property, if I ran a cost segregation study, I may be looking anywhere from, on the short end, $75,000 to over $100,000 in after-tax savings. So whatever my tax obligation is to the IRS that year, I get to deduct from that amount, which is tremendous, right? So I've got $100,000 that's going to save in my pocket rather than paying to the IRS. And you get to utilize it indefinitely. So there's something called the carry forward clause. So if my tax obligation is not over 100,000 in the first year, well, it carries forward until that whole sum is used up. That's why I see a lot of times investors typically will not have anything to pay their first year, but also wipe out their tax obligations in future years, sometimes 3, 4, 5 years down the road. Now, with that free up of cash flow, they either, one, go purchase more property. If I've got $80,000 tax savings, I'm going to reach out to Aaron and say, hey, let's go buy another multifamily unit. I've got the down payment right here. Or if I'm already sitting on a couple of short-term rentals, 80,000 goes a long way in renovating them. I can, dress them up to the nines and make sure that my reviews are consistent. Or if I'm a real estate investor that's sitting on a quite a big portfolio. I'm going to take that 80,000, and my wife and I, or my partner and I, we're going to go on a trip around the world. Why? Because we deserve it. It's my money. I'm going to do what I want with it. So that's really the benefit of cost segregation, that it's identifying components within a building, and it's allowing you to accelerate those components within the earlier years so you can reap that tax savings early on. And it all comes down to the time value of money, right? The time value of money states that my dollar today is worth more than my dollar tomorrow. Same as my depreciation today is worth more than my depreciation tomorrow. Now, one of the first common misconceptions I hear with cost seg is that you're not getting any more, you're not getting any less, right? You're basically tipping the depreciation schedule on its head, and you're receiving it in the earlier years instead of the later years. Why? Because I don't know if I'm going to be around 30, 40 years as I'm owning this property, and I don't want to wait 40 years to receive the total tax benefit down the line. I want it today. I want my money today, and then I want to buy another property, the same thing. There's a lot of intangibles that can go on. So that's why we really like to follow the time value of money constraint, that your dollar today is more powerful than your dollar tomorrow. So might as well utilize it if you can.
So you threw a lot at us there, but it was great information, and I just want to make sure that I heard it correctly. So for Airbnb short-term rentals, you can accelerate the depreciation on certain classes for a longer period of time than you can for multifamily, right?
Well, generally speaking, so let's touch upon reclassification. That was a little bit of terminology I threw out there without any definition behind it. So reclassification is the term that is put towards how much of the property can be reclassified for accelerated depreciation. In a typical short-term rental, that's going to vary between, on the low end, 20%. If it's a high-end Airbnb, like the one I gave an example, $1 million property, or 750 plus, you're probably looking anywhere from 40+% of the purchase price being identifiable. In a multifamily building, it's going to be close. Low end might be 15, upper end might be 40%. Once again, it all depends on the property type, the purchase price, what type of renovations you put into it, the different amenities that go into it. So they're both going to perform very well from a cost seg standpoint, very similar. I would say short-term rental just probably takes the cake a little bit further, because you can put a little bit more upgrades into that property.
Okay, so let's take that $1 million Airbnb, for example. If that property was generating, let's say, $200,000 in gross revenue, and after expenses, let's say we net $150,000, how much of that can we, or is exempt, or how much of a tax obligation can we reduce using a cost segregation study?
Yeah, so you're looking at the reclass of a short-term rental is going to be on the low end 20%, upper end 40%. So let's just use 30%. It's right in the middle, and I'd say it's pretty average for short-term rentals, whether it's a $500,000 property or $1 million property. 30% is pretty good. So you're looking at about, as we kind of did our example here before, if you're in the upper 30 percentile tax bracket, you're close to that $100,000 tax savings range. So if your obligation to the IRS that year is, say, $100,000, they've washed. It's completely washed. So you're not paying any taxes to the IRS. This is only one of the ways that I know that you can essentially wipe out your tax obligation and not pay any taxes to the IRS, but still have income that you performed on. That's it in a nutshell, right? So you've made money, you've made profit, you have a tax obligation to pay the IRS. This is what's going to offset that tax obligation in the form of accelerating your depreciation.
That's incredible. So if I'm a high income earner, maybe I make more money outside of real estate than I do with my actual real estate. Let's say I did this study and I was able to lower my tax obligation. It applies to all of my income, right? Not just my real estate income.
Yes and no. So once again, it all depends. And this is where I really strongly suggest, you reach out to a tax advisor and accountant. I'm neither of those, but I will give you the tee up for it, so you can bring it up to your tax advisor and specialist. So as we talked about, there are rep status rules. So that stands for real estate professional status. In a short-term rental, if you're a high income earner, yes, there is an opportunity for you to, quote unquote, double dip. and be able to apply this tax savings not only to your real estate investments, but then also to your personal income. Now, for a short-term rental, there's a couple of criteria that you have to meet. One is a 100-hour test. You have to be able to document and showcase that you put 100 hours into the Airbnb rentals or the short-term rental. There's a couple of other criteria. This is why I strongly suggest you reach out to a tax advisor, CPA, to make sure that you qualify for the status. But if you do, yeah, 100%. They call this the short-term rental loophole, which is we're starting to see this emerge. I mean, tremendously. It's one of the hottest markets right now for professionals and high income earners. We see a lot of tech income earners, a lot of medical nurses, lawyers who, they're generating a lot of income through their practice, and they need a place to put it and park it. Well, Airbnb rentals and short-term rentals happen to be a very tax proficient area to park this money and then even apply that tax savings back to themselves. So cannot strongly suggest again, make sure you reach out to your tax advisor and your CPAs to make sure that you qualify. But if you do, ask them about the short-term rental loophole, because it's one that's very advantageous.
It's funny you say that there's the short-term rental loophole. It's funny that you call it that, because there's actually a lot of loopholes with short-term rentals. One being that you can buy a short-term rental as a primary residence, and as long as you occupy the home for at least 6 months out of the year, you can still run an Airbnb operation out of there and use 3%, 5% minimal down payment strategies to get into the property. So I think that's a nice hybrid sector of the market where you can generate returns on maybe a second home, classify it as your primary residence, and still have that nice beachside property that you and your wife have always dreamed about, and get into it for pretty low barrier to entry, and use it, vacation at the property, enjoy the property, whenever it's not being rented out. So, and it comes with some amazing tax benefits as well. So mortgages, tax benefits, they're not always the sexiest things to talk about, but these can be the catalyst to helping you accelerate your wealth and taking those next steps towards building your portfolio. So I think we covered a lot of good topics today. Was there anything else you wanted to kind of unpack?
Maybe just summarize. And actually, I didn't know about that last part, so that's good to know. And I think if our listeners, if there's one thing to pick up, it's surround yourself with experts in the industry, experts in the field. Mortgages, real estate, it sometimes isn't sexy for those who it just may go over your head. But if you're looking to, reshape your world, really create generational wealth, this is the way to do that. And one of the ways that I like to summarize it is purchase, defer, exchange, repeat, right? So first, find a property, use a professional like Aaron, find a property, purchase it, and then defer your tax obligations in the way of a cost segregation study. And then also on the exit strategy, defer your capital gains through way of a 1031 exchange. So we haven't really talked about this too much, but if you are looking for a little more information on exit strategies, 1031s or deferred sales trusts might be one of your options. But take a look at our previous video that I did with Scott Saunders of Asset Preservation. He's been a qualified intermediary 1031 specialist for the last 30 years. So he's got a wealth of knowledge. Check that link in the bio here. But yeah, I think we've really touched on a lot of things. First, how to get real estate investors into the market if they haven't done so, or if you have been investing in real estate for a while now. Here's a tool, here's a tax savings tool, cost segregation that you can apply to just put kerosene on the fire and just unload and find more properties to purchase.
Absolutely, a lot of great stuff here, and knowing your motivation, how to get into the market is key. Also, knowing the market, right? I think whether you're ready to buy, it has more to do with where you're at than where the market is. There's always investors making money in an upward trending market and a downward trending market. Fortunately, we live in Florida, one of the best real estate marketplaces in the country. So we're definitely blessed there with, year-round favorable weather, the tax climate, very pro-business environment. So there's no reason you should not be investing, even with rates where they're at and the economic climate. There's still plenty of opportunity in these secondary markets if you can't afford to be in the primary one. But I think we covered a lot of great topics today, and hopefully equipped our listeners with some good information that can help them take that next step towards, becoming good, profitable landlords.
Exactly. Yeah. And if you do have any questions or want to follow up, Aaron, let's hear your plug again. How can they reach out to you? And I'll put that here in the chat so they can find you. But, for our listeners, let us know about the stuff where they can find you.
Yeah. So just my first and last name, Aaron Abbadie, on both Instagram, LinkedIn, Facebook, wherever is easiest for you. Every Wednesday, I do publish a newsletter on multifamily real estate on LinkedIn. If you haven't subscribed to that, please do let me know if there's anything you want to learn more about. Today, my edition will be on cost segregation and the illuminating conversation we had today. So definitely keep an eye out for that. And then on YouTube, I'll post some of my more long form content. So this will definitely be on there as well.
Excellent. Perfect. And then for anyone that's looking for information or follow-up on cost segregation, estimates, analysis, studies, or just common questions, you can find me on LinkedIn as well, Sean Lichterman. I'll introduce my plug down below so you can reach out, email, or phone call. But maybe we'll do a follow-up as you're helping me find my first multifamily property, and then we can actually do a behind the scenes of what it actually looks like. I think that'd be great for our listeners. And as I'm diving into multifamily industry, I think that's going to be very exciting to document as well.
Absolutely. I think it'd be great for us to share kind of what's going on behind the scenes and all the way up until the closing table. I'm sure there'll be a lot of fun experiences to share, and we'll build a nice little following around your first acquisition. So that would be great for everyone, I think.
Excellent. Well, best of luck, Ben. I'll talk to you. I'm sure we'll be in touch. What am I talking about? We're going to be in touch very soon. But thank you for coming on the Q&A today and giving us, a deep dive into your experience of multifamily investing in the market.
Likewise, this was great, and I'm definitely going to be sending some more clients your way for cost segregation and tax saving strategy. So thank you, Sean.
Awesome. Appreciate it.